All right. So this contract is called a derivative. And in this case, gold is called the underlying. It's one word. I'm just writing it in 2 lines. So this contract is a type of a derivative contract because the value is derived from the value of something else, and that something else is called the underlying, the main asset depending upon which the value of this contract will be decided. Okay, Sumit is asking, I did not do an advance payment. Maybe you did a token amount. Maybe you paid maybe 5,000 or something in advance, but the price you will pay, that advance is just an asset liability management. That will be adjusted against the total 50K that you have to pay. Okay, it doesn't change your profit or loss. It is just to seal the contract, you give a token, but it doesn't affect your profit and loss. Is this clear that what are the features of this forward contract? Why it is called a derivative? What is a derivative? What is an underlying? Any questions related to this? If not, then we will move forward and we'll explore forward contracts in a little more detail. Okay, I guess no questions. Okay, Shravanji is asking, is arbitrage value the right phrase? It might have value not just due to arbitrage opportunities, it might have value due to speculative properties also, due to speculation in the market. So why it has value? The reason for that could be arbitrage opportunity. The reason for that could be speculation. The reason for that could be volatility in the market. But in any case, one thing is sure and always certain, that the value of this contract is always derived on the basis of value of gold. Hence, it is called a derivative. Why gold is called underlying? Simply because underlying this contract, the foundation of this contract is gold. As the price of gold changes, the value of this contract will also change. Because accordingly, I will make a profit or loss. You saw that when after entering into a forward contract with the jeweler, if the gold prices moved up, I'm making, or you are making a profit and the jeweler is making a loss. If the gold prices move down, reverse is happening. So in every case, the value will be derived from the value of the underlying asset. In this case, it is gold. It can be any commodity. It can be oil, it can be wheat, it can be maize, it can be metals, it can be shares. Okay, we'll discuss those in detail. Is gold underlying asset and value changing? Yes, that's true. So as the value of gold is changing in the market, the amount of profit or loss in this contract will be decided according to that. Hence, the value of this contract will also change. Arindamji asked a very nice question. If the gold merchant does not want to sell at loss and exits the contract, is there any mediator in this case, or the contract will default in such a case? We'll discuss this. All right. So this was the concept of a forward contract and one example. Now, what do you think? Who uses forward contracts and why? Can you give me some examples other than obviously buying jewelry, but commercially also? Oh, you can't see the video? I think my webcam is on. Yes, maybe some problem because others are saying it's on. Okay. Yes, you're giving right answers. Sugar mills, companies which need raw material, farmers, rice, property dealers. See, it happens a lot. Manufacturers to lock in raw material cost, jewelers, gold ornaments. Perfect. So all these are right examples. It happens very often, particularly in the case of commodities where you need it at specified period, at specified point in time, and in large quantities. You tend to normally companies tend to enter into forward contracts. I will give you some more examples which none of you have given. I'll discuss a few more examples. But before that, let's come back and discuss this in a little more detail. For example, um, any company, for example, a company like Britannia or any company that ITC that makes biscuits. Now, it is uh, by the time the biscuit reaches your plate, the planning for that has already been on for several months, because before that it reaches the C&F agent, before that it leaves the factory, it takes a little time to produce, and before that raw material needs to be procured. Sometimes some of the raw materials are seasonal in nature, so it may happen that for some raw materials the company might need to plan the exact requirement for the whole year and so on. It's a very complex process, right? And if the company is left to the mercy of market, completely at the mercy of the market, then it might become disruptive. There might be times when it doesn't have raw material, or it has to pay too much for the raw material. So in such cases, typically the company would enter into a forward contract with the farmer, that I will procure all the maize or all the wheat that you are going to produce, so much quantity, such and such quality, at such and such time, at such and such price. Okay, so they have an assurance that they will get so much wheat directly from the farmer at this price at this time. At the same time, don't forget, it's also good for the farmer, because the farmer already knows 3 months in advance that when my crop is ready, I have a contract with the buyer, and so he has certainty. Okay, he is not worried about what the price will be at that time. Okay, he's fixed it in advance. So this is one example of who enters into a forward contract and why it is beneficial for both of them. But what is the downside? What is the risk of entering into a forward contract? I think one of you, I think Arindamji had asked this question. What if the jeweler defaults? Suppose you entered into a forward contract for buying gold and at 50K, and the prices moved up to 60K. Now, after 1 month, when you go with 50,000 and the jeweler refuses, or he just refuses to honor the contract, then what are you going to do? What is the recourse available? Some of you are saying that screen is not visible. I'm not writing anything on the white screen right now. Yes. So my question is, if the jeweler refuses to honor the contract, what are you going to do? Do you have any recourse? Okay. So Ramuji is saying you'll never enter into a forward contract again with him. Of course, you will not do that. But what will you do about this one? In future, you will never transact with that person. You will go and tell everybody this person is a cheat. Fine. What will you do about this contract? You were supposed to get the gold for 50,000. Now he's refusing. What are you going to do? There's nothing you can do. Well, there is a contract. There's a breach of contract. You can file a case in the court for whatever remedies are available under Indian Contract Act. That's all you can do. But there is you cannot in any way guarantee that the contract will be honored, settled, etc. All right. So you can take the legal route. Of course, you can do that. But there is no remedy immediately to solve your problem. You will have to go buy gold in the market at 60,000, and then later on you pursue the legal remedies with the person. That's a different thing for breach of contract. So there's a big problem with forward contracts. Forward contracts are also called OTC, over the counter contracts. These are over the counter contracts. What is the meaning of over the counter? When you need to buy something from a retailer, you just go there, take the stuff, pay the price. It is all done over the counter. There is no one in between. You are directly dealing with the seller. The buyer and seller are directly dealing with each other. So this is basically a private contract between two individuals. Well, I don't mean individual, between two parties, let's say. It can be a company also, not necessarily an individual. A company buying from a farmer, etc. So it is a private contract between two parties, and there is no intermediary. There is no person in between. There is no middleman. There is no regulator. In case the party refuses to honor his or her part of the contract, then you have no recourse, no remedy, except you can file a police complaint, take legal remedies, etc. Those are different things. But other than that, there is no mechanism for redressal of your grievance. All right. So the risk, there is risk in this contract. There is default risk, or also known as counterparty risk. Okay, there are some questions related to options. Okay, we will discuss them tomorrow. Right now, let's just focus on understanding what is a derivative, what is a forward, and what is a future. Right? So in the case of forward, this is a privately negotiated, customized contract between two parties. It can be, I want 10 grams of gold, someone else wants 25 grams of gold, someone else wants something else. So there is no standardization. Okay, this is absolutely customized between two parties privately negotiating and agreeing to form a contract. There is no one in between to ensure the performance. So there is a risk of default. There is a counterparty risk. Okay, this is a big limitation of a forward contract. The other limitation of a forward contract is, since these are over-the-counter products, over-the-counter contracts, and privately negotiated, and there is no standardization, there is also a problem of liquidity. What I mean by that, in case you want to buy the, in case you want to enter into such a contract, you have to go find a jeweler who's willing to enter into a contract to sell the exact quantity and quality of gold that you want to buy. It is not standardized. It is not easily available in the market. For example, if you want to buy a Cadbury chocolate, a Kit Kat or a 5-star or a Dairy Milk, some chocolate, okay, it is available everywhere. It is available in the same standard quality and quantity and same packaging. You can buy it from the store in the next lane, or you can go to a big supermarket. Okay, it's not about the value of the thing. Even if you want to buy something expensive, let's say you want to buy a car for 25 lakhs, you can buy it in any city. It is standardized. There's a market for it. You don't have to negotiate privately with the car maker that, I want this kind of a car, you make it for me, customized. That happens in the case of Rolls-Royce. But generally, when you want to buy a car or whether you want to buy a chocolate, because it is standardized and it is easily available everywhere, there is no liquidity problem. At least you don't have to search, you don't have to ask 10 jewelers and find one who's willing to enter into a contract. So these are the two major limitations of a forward contract. One is liquidity, and the other is a default risk or a counterparty risk. In case the other party refuses to honor his or her part of the contract, then you are stuck. Then there is nothing you can do about it. So once again, since there's a question, counterparty risk is just this, that if the counterparty does not honor his or her part of the contract, either does not give you the money or does not give you the gold, that is a risk that might happen. That is counterparty risk. And liquidity risk is, it's not a risk, it's a limitation. Liquidity simply means if you want to enter into a forward contract for gold, you want a certain quantity and a certain quality of gold. So you have to go around looking, and you might have to ask 10, 20 jewelers and find someone who's willing to enter into a contract to sell that quantity, that quality of gold on that particular day. All right. So you have to go looking for it. It's not easily available because you have to customize. It is a customized contract and between two private parties. But if you want to buy something that is standardized, that is available everywhere, liquidity is not an issue. Whichever part of the city you are, you can get the same chocolate, and you don't even have to worry who the shopkeeper is. You don't have to know the shopkeeper also. And you may not like his face also. You may not like his attitude also. But you know that you are giving 10 rupees or 50 rupees and you're getting this bar of chocolate. You know what the quality is. You know how much the quantity is. You know the brand. All right. So it's easily available everywhere. That is the other limitation of a forward contract. Forward contracts, usually they don't happen in standardized way. So you have to negotiate privately. You have to find the right seller or buyer. You have to find the right counterparty. I hope this is clear. Why it is called over the counter? Over the counter is just a general term. If you talk about medicines, there are certain medicines which you can just go to the pharmacist, the medicine shop, the pharmacy in your neighborhood, and you don't need a prescription. If you ask for a crocin, he will just give it to you. So these are called over the counter. The transaction just happens. You give the money and take the medicine. But if there are certain drugs that require a prescription from a doctor, they are not called OTC drugs. Over the counter just means that between two individuals, the contract is happening. Two parties, privately, the contract is happening. OTC is a generic term. It's a general term. It is not a derivative related term. All right, let's move on. So we discussed what is a forward contract. We discussed what is a derivative. You can enter into a contract to buy gold or wheat or coal or oil at a future date. That is called a forward contract. Similarly, you may also enter into contracts to buy, let's say, currency or sell currency or buy or sell shares also at a future date. But normally what happens is, let's talk about shares. These problems with the forward contract, counterparty risk, etc., etc. So you can enter into contracts, similar contracts for shares also, but they are traded on an exchange. Well, you can always enter into a private forward contract with anyone you like. That is fine. But if you want to buy it in the market, there is a readily available market for that. It is through the exchange that these contracts are traded, and these contracts are standardized. Okay. Now, when they are standardized and exchange traded, it is called futures. Futures. Futures or future contract, whatever you want to call it. So you can similarly enter into contracts for buying shares also, but they are exchange traded, they are standardized contracts, and they are called futures. So because there is a market for it, that is the stock exchange, you don't have to go looking for a buyer or a seller. If you want to buy a share of HDFC Bank or Reliance or any other company that is a public company, you don't have to advertise on social media or try to look for a seller. You just go to the stock market, right? There's a ready exchange. All the buyers and sellers come there, maybe not physically, but through online means. So liquidity is not an issue. And also, since it is exchange traded, when you trade into forward futures and options, you are required to deposit margin money, etc. We will discuss all of that in detail. Okay, don't worry. So there is also no counterparty risk, because when you are doing any transaction through a stock exchange, you are not really dealing with the counterparty. You don't even know who the counterparty is. You just want to buy a share, you go to the stock market, you log into your trading account and you place the order, and the exchange finds another person who's willing to sell at that price. You don't know the name, you haven't seen the face of the person, but the transaction happens because the exchange is there as an intermediary between you and the seller, or between you and the buyer. All right. So the exchange is, for you, the exchange is the counterparty, and for the other person also, the exchange is the counterparty. Exchange is the intermediary in between. It'll never happen that you sell a share on a stock exchange and not receive your money. If you're doing it through proper channel, it'll never happen that you don't receive the money. Exchange guarantees that. So what were the limitations of a forward contract? Those are taken care of in the form of futures, because it is exchange traded, the exchange acts as a counterparty. Also, they are standardized contract. You don't have to go looking for a person. You go to the stock market, you'll find someone or the other who's willing to buy or sell the same thing. All right, is this clear now? Let's just understand. We've understood this with the example of gold. Let's quickly understand what is the implication when you are entering into a futures contract. It's exactly the same. XYZ Limited. If you open up the website of all these news channels, business news channels, or you log into your trading account or through the mobile app, you get to see a price. Suppose this is a listed company on the NSE, National Stock Exchange, XYZ Limited. You will get to see a price. Suppose the price is 100. This is the spot price. This is called the spot price. Spot price means you can buy one share of XYZ Limited right now for 100 rupees. Okay. If you log into the derivative section, if you open up the derivative section, you will also see the futures price. And let's say the price is 110. What this means is, if you buy a future of XYZ Limited, see, if you buy spot, then you will have to pay rupees 100 and you will get one share in your demat account. Okay, but what happens if you buy a future of XYZ Limited at 110? First of all, you will not get anything in your demat account. You have not become a shareholder of XYZ Limited by buying the future. If you remember the gold example, what was happening? I was promising to buy gold after 1 month for 50,000, 10 grams. And the shopkeeper was promising to sell the gold to me after 1 month, 10 grams for 50,000. Have I purchased the gold today? No. Do I have the gold today? I don't. Okay, so I'm just promising to buy and pay 50,000. Similarly, when you are buying XYZ Limited futures, today you are just promising to buy one share of XYZ Limited at the rate of 110. However, when you enter into a futures contract, see, when you're buying in the spot market, you can buy 1, 2, 3, 4, 5, whatever quantity you like. When you are entering into futures contracts, and tomorrow we will see about options as well, you cannot buy 1 or 2 or 3, whatever quantity you like. There is a lot size. Lot size means, suppose the lot size is 20. Okay, then you can buy 20 contracts, or you can buy 40 contracts, or you can buy 60 or 80. That means in multiples of 20. You can buy 1 lot, 2 lot, 3 lot, and each lot will have 20. You cannot buy 25. You cannot buy 47. All right. So, and this varies from share to share. So you have a lot size. Whenever you enter, whenever you want to buy the futures of a company, you are not becoming the shareholder, you are promising to buy the share, and you have to check the lot size. So you cannot buy any quantity. What is the reason behind these lots? Very good question. One reason is, we will see what is the effect of buying futures and options. Okay, in a short while, we will see that why it is more risky. Derivatives are the most amongst the most risky investments. So one reason is that uh, when there is a lot size, you cannot enter into the derivative market with any amount. You need to have a certain minimum corpus. Okay, so you cannot trade into the derivative market maybe with sometimes with 5-10,000 rupees. You need, if you're buying futures of companies, you need a little more money than that. So the government doesn't want, the regulator doesn't want the small traders to be affected. They only want people who have more money, only they come into the derivative market, because it is very risky. This is for protection of the small investors or traders. The second thing is, uh, this is also about standardization. So I'm not punching orders for random quantities. So that order matching is easier if there is standardized lots. So that is the second reason. All right. Any questions on this so far? I will talk about the exit of the contract. We will discuss the delivery. But any questions so far? Is this concept absolutely clear? That when you are buying futures of XYZ Limited, you are not buying the shares of XYZ Limited. Okay, you are only promising to buy the shares. And after you've entered into the contract, let's discuss what happens after you have entered into the contract. So suppose the spot price was 100. At that time, the futures price was 110. Okay. Suppose I purchased one future contract. Now I know one future contract is not possible. There would be a lot. But just to keep the example simple, let's assume that I can buy one future contract also. So I purchased the future contract. After that, the prices of XYZ Limited started moving up. Okay. And in about 15 days time, the price moved up to 120. This is the spot price after 15 days. Okay. This 100 has become 120. So this 110 would have also moved up. Maybe it has become 125 or 130. I don't know. Let's say 130. All right. So am I making a profit on this? Yes. Now I can either wait till the end of this contract. This contract is expiring after 1 month. So I can either wait till the end of the month, and at that time we will do a settlement, or I can exit the contract today also. Let's understand this with an example. XYZ Limited, right now the spot price is 100. The spot price is 100 and the future price is 110. After 1 month, the spot price is gone up to be 120. Okay. This contract is also expiring on this date after 1 month. After 1 month, what will be the future price? What will be the value of this contract? This will also be 120, because initially there is a difference between future price and the spot price, but on the day of expiry, this is the contract is expiring right now. It is expiring today. So can the future price be very different from the spot price? No, that is not possible. If you buy it in the spot market today, it is available for 120. So the future contract expiring today is also available for 120. So typically what we see is that, suppose this is the price and this is the time. Okay, this is the graph. The spot price, even if it is moving up over a period of time and closer to the expiry, you will say that the future price and the spot prices converge. This is the future price and this is the spot price. Okay, and this is time. So as we move ahead in time, as we move close to the expiry, the future and the spot price will tend to converge. And on the day of expiry, that is when the contract is coming to an end, on that day, the future and the spot price will be exactly the same. Even if the prices fall, it is going to be the same thing. So this is the spot price. If this is falling, the future price, upon expiry, the two will converge. All right. Now, how do you make a profit and loss, profit or loss? XYZ Limited, spot price was 100. The future price was 110. After, suppose you purchase the future contract of 110. After 1 month, the prices have moved to, let's say, 125. Today, you have not purchased the share. You have purchased the futures contract. Today, you have the contract to buy 1 share of XYZ Limited at the rate of 110. But it is available in the market for 125. So what you can do is basically you can buy the share for 110 and immediately, because in the market right now the price is 125, sell it for 125 and make a profit of 15 rupees per share immediately. Okay, you are not buying and holding the shares over here. You are just promising to buy for 110. On that particular day, the market rate is 125, but you will get it for 110 because you entered into a future contract 1 month in advance. So you can buy the share. This is like what is available in the market for 125. You will get it for 110. So it is a profit of 15 rupees. Or you can see it in another way, that you are going to give 110 rupees, get the share of 125, and in case you don't want to keep it, you can immediately sell it and make a profit of 15 rupees immediately. You pay 110, get the share, sell it, 15 rupees profit. All right. This is when you entered into a contract, and this is called expiry of the contract. Remember, when we started discussing futures and forwards, the first thing that we discussed is the execution happens at a specified future date. That specified future date is called the expiry date. That means when the contract is expiring, when the contract will be executed. So you can buy the contract, hold it till expiry, and upon expiry, this is how you make a profit. But if the prices did not move according to your expectations, so the spot prices were 100, the future prices were 110. In 1 month's time, the prices declined to, let's say, 90. Now, when the contract is going to expire, the price of the share is 90. Okay. So what is available in the market for 90 rupees, you are forced to pay 110 for that. Therefore, you are making a loss of 20 rupees per share. Okay. This is when you keep the contract, when you hold the contract till maturity or till expiry. Any questions about this? Whatever we've discussed till now, there is some more to go, but whatever is covered so far already, any questions on that? I will talk about exiting before expiry. I have not covered that yet. Can we sell futures before expiry? I will talk about that. Okay. So you want me to explain this once more? No problem. See, today, XYZ Limited today is trading for 100 rupees per share in the spot market. Suppose we are in the beginning of June, and you also have the future market where it is trading for 110, let's say, same example. Okay, that means end of June, whatever the date is, it is the last Thursday of June. Let's say 30th of June. It might be some other day, it is the last Thursday, but let's say 30th of June. So you don't buy a share, you buy a future contract for 110. That means you are promising to buy one share of XYZ Limited on 30th of June for 110 rupees. Okay. Now, what happens in this 1 month? The share prices go up. Suppose the prices have moved up to 130 rupees. On 30th of June, the market price, the spot market price is 130 rupees. But you have a contract where you have promised to buy one share for 110 and someone has promised to sell it to you for 110. Then only you have a future contract, right? So you can get the same share for 110. What is available in the market for 130, you can get for 110. So this is 20 rupees per share profit, because you are getting it 20 rupees cheaper, simply. Okay. Now, is this clear how the profit and loss is calculated? Now, at the time of expiry, let's discuss it here. At the time of expiry, you can have two options. One thing is that you actually pay 110 rupees and take the shares. All right. The other option is that you just get the 20 rupees difference. When you pay the entire 110 and get the shares, that is called delivery. Okay, but suppose you don't really need the share, or let's go back to the gold example. Suppose you did not enter into a forward contract with the jeweler because you wanted the gold. You were just speculating. You thought gold prices will go up. Let me enter into this contract and make some profit out of it. All right. So in that case, you are not even interested in the gold. You will get the gold for 50,000 and sell it in the market immediately for 60,000, making a neat profit of 10,000. Now you tell the jeweler that, listen, we will do all this transaction. I take the gold from you for 50. I sell it to back to you or someone else, some other jeweler for 60. Just give me 10,000 profit and we don't have to do this transaction. That is called cash settlement. Okay, so either I can pay for the share and get the share in my account and then sell the share, that, or keep the share if I want to. That is called delivery. Or I can just get 20 rupees, the net profit or loss. In this case, it is 20 rupees profit for me. So I can just receive 20 rupees and I won't be paying 110 and getting the share and then selling the share. I don't have to do all the transaction. I can just do it on the basis of a cash settlement. When you do it on the basis of cash settlement, uh, you just get the profit, or in case it is a loss, you just pay the loss. You don't really get the shares in your account. Now, what happens practically is, in case of uh, the stock markets in India, for shares, you have to do a delivery-based settlement. Earlier, earlier it was cash settlement, but to reduce the volatility, to reduce the speculation in the market, the regulators made it delivery-based. But if you're buying index futures, then it is cash settled. Okay, this is, I have just spoken about expiry. Exiting before expiry, I will cover. But right now, just understand what happens if you buy the contract and keep it till expiry. Okay, let me see any questions until now. Difference between futures and options. When we cover options, it will be clear at that time. For now, just hold this question till tomorrow. Is it possible that spot price go up and future price go down? Normally, spot and future price move in the same direction. It is rare. Theoretically, it is possible, but it doesn't really happen. Because if the prices are moving up, the whole market believes that this underlying, whether it is a share or a commodity, is going to be more expensive in the future. What do you expect? The future prices will also be up, right? If you exit today, okay, that is a scenario, squaring off, exiting. We have to discuss that. I haven't discussed that already. So please wait for a while. Okay. When we get one lot very cheap compared to the stock price, but at expiry to take delivery, need to. Yes, I will discuss about that. So about the margin requirements and how it is more dangerous, how it is more risky. All transactions in futures are always based on lot. When you're buying the futures, you have to buy a minimum quantity, that is one lot. Depending upon the share, that lot size could be 50, it could be 100, it could be 500 also. Okay, and when you have to take the delivery, that is also for the entire lot. Can the future contract price be less than spot? Yes, it is possible. If the market believes that in the near future the prices are going to go down, but again, that rarely happens. Can you please explain IM and VM? Okay, I'm not sure what are you implying over here. IM and VM. Can you please elaborate? What is index? Okay, let me explain what is index. Spot price and future price similarity once again. Can we get arbitrage opportunity in spot price and future price? How is the lot size of share decided? Option delivery. Okay, fine. Lots of questions. So let me handle them one by one. Okay. Difference between, let me repeat, difference between cash and delivery based settlement. Let's go back to the gold example. So 10 grams of gold at the rate of 50,000 after 1 month. Suppose after 1 month, the market price of 10 grams of gold is 60,000, not 50. Now, I can still go to the jeweler, give him or her 50,000 rupees cash and get 10 grams of gold in exchange. Okay, if I really need the gold, this is called delivery because I am taking physical delivery of the 10 grams of gold. Okay. The other option is, suppose I'm not really interested in gold. The only reason I entered into this contract was because I believe that the prices are going to go up and I can make a profit out of it. Even if I pay 50,000, get the 10 grams of gold, I'm going to sell this to someone else for 60,000 because I don't want to keep the gold for myself. I'm just interested in the profit. So I pay 50,000, get 10 grams of gold. I go to some other shop or maybe the same shop and I sell it back for 60,000. I make a profit of 10,000. Instead of doing all this transaction, I just tell the shopkeeper, you just give me 10,000 rupees because that is the profit I have made and that is the loss you have made. I can do that by taking the delivery and then selling it off indirectly, or I can just get 10,000 rupees from the shopkeeper. Then this is called cash settlement. All right. So in delivery based settlement, you actually take physical delivery of the underlying, whether it is gold or a share. If it is a share, you actually have to buy those many shares by giving that much cash. Or in cash settlement, you just receive the profit, or in case it is a loss, you just pay the amount of loss. You don't have to do the entire transaction. Another question was, I'll talk about margins. Just hold on for a little while. Square off, exiting before expiry, margin, all of that I'll explain. First, let's make sure that everyone is clear about the basics. Okay. Now, there was another question about what is an index. So I'm sure you might have, since you're interested in this course, you already know National Stock Exchange. And there's another one, Bombay Stock Exchange. Whenever you open the news, business news or elsewhere, you might have heard names like Nifty 50 or Sensex. These are words I'm sure you would have heard. What is Nifty 50? Of all the companies listed on the National Stock Exchange, the 50, one of, amongst the largest 50 companies in all, covering around 13 or 14 different sectors like banking, like auto, like telecom, consumer goods, manufacturing, engineering, IT, etc. There are metals, mining, there are different sectors, right? So from 13, 14 different sectors, the largest companies that are listed on the National Stock Exchange, 50 such companies together form the index called Nifty 50. So when you look at the news, they say Nifty has fallen or risen, or Sensex has fallen or risen. What it means is that on an average, suppose I say Nifty moved up 1% today. What it means is that these 50 companies, on a weighted average basis, that means large companies obviously have more weightage, but on an average, these companies have moved, the prices have moved by 1%. They have moved up by 1%. It is possible that out of this 10 companies, the price actually went down, remaining 40 price went up. It is possible. This 1% is only the average of these 50 companies. So just by looking at Nifty 50, you get an average sense of what is happening in the market, at least for these 50 large companies. Similarly, there are other indices also. This is just the top 50. Then you have index for Nifty 100, then you have 200, you have mid cap, you have small cap, you have index for different sectors also, like Bank Nifty, so on. So it gives you an idea that on an average, what has been happening in the market. And just like you have futures for a share, you can also buy futures for Nifty. That means you can buy index futures. And then after you purchase it, if the index is going up, obviously the future price will also go up. It works exactly the same way like shares, but only difference is that if it is an index future, you cannot take delivery. So you have to do cash settlement. That means if it is a profit, you will receive the profit. If it is a loss, you will have to pay the loss. We'll discuss the mechanism of that. All right. So this question is clear. What is an index? You can also have index futures. And tomorrow when we discuss options, we will also discuss index options. So difference between delivery and cash settlement is done. The spot prices and the future prices. Okay. So suppose in the beginning of June, you want to buy a future contract of any company listed, any listed company XYZ Limited. Okay. You can buy a future contract. Typically, there will be three types of contracts available, three time period contract available. One that is expiring in June itself, on the last Thursday of June. Next, on the last Thursday of July, and then last Thursday of August. All right. So these three contracts will be available. Suppose you want to buy the contract that is expiring on the last Thursday of June. So right now, this is the graph. Okay. This is now. This is end of June, last Thursday of June. This is when the contract is expiring. This is the spot price, 100. People are expecting that in future, the price will move up. So let's say the futures are trading at 115. Okay. Now, the price moves up, moves up, moves up. When you reach end of June, the prices are actually 116. Okay. What will happen to the future price? The future price will converge, and on the date of expiry, see, on the date of expiry, what is happening is, if you are buying a future contract, Over here, you are buying a future contract. The execution would happen after 30 days or 25 days. It will happen end of June. Okay. But on the date of expiry, as soon as the market opens in the morning, you are buying a future contract that is expiring on that particular day, expiring in June. All right. That contract is expiring on the same day. How different the prices can be, the spot price and the future prices. As the expiry date comes closer, the spot and future prices tend to converge. Because on that same day, how much can the price move? See, when the prices are different over here, it is understandable because it is in the spot market 100, but after 1 month it can be 115. The market believes that the prices will move up. But if you are buying on the expiry day in the morning or at 10 o'clock or 11 o'clock, you are buying, that contract is expiring on the same day when the market closes. How different can the prices be? And suppose you are buying the contract not at 10, 11 in the morning, you are buying at 3 o'clock in the afternoon when the market is about to close. You will see that the future price and the spot price is almost the same because the future is also almost the spot, right? The contract is expiring on the same day. At market close, ideally the future and the spot price will be identical because there's no future now. It has become present. Okay, I hope this is clear. Okay. Oh, there's a question. Does underlying beta have the same impact on future contract? See, please understand this. Just give me a moment. Yeah, please understand this. Beta is basically relationship between a particular share and some other, let's say an index. Maybe you want to see that how is the return of this share compared to return of a comparative index. Like if it's a large cap, what is the large cap index, how much return it has given, how much it has moved, compared to that, how much this particular share has moved. Okay. But when you talk about futures of the shares, it is impacted only by one thing, that is the movement in value of the underlying. In this case, if you're buying a share, then if you're buying futures of a share, let's say XYZ Limited, then the underlying is XYZ Limited. If XYZ Limited is a high beta stock, obviously the prices are going to move a lot more than the average, than the index. So if the prices of XYZ Limited move a lot, the prices of the futures will also move a lot because the value of the future is completely linked to XYZ Limited's spot price. And if that is volatile or if that is moving a lot, then the future price will also move a lot. The value of future contract is always derived from the value of the underlying asset. So yes. Again, difference between futures and options. When we cover options tomorrow, it will be clear. Rollover, yes, we'll discuss rollover. Okay, let's go back. So We purchased a future contract. The scenario we've discussed right now is we purchase it and we hold it until expiry. We hold it until expiry. Now, suppose I purchased a future contract and within 1 or 2 weeks or within a few days, the shares have moved up. I'm already in a profit situation. Now I'm fearing that there might be a correction again. And if I have to wait till expiry, what is going to happen is I might lose this profit again. Like you purchase the futures at 110, the spot was 100. Let me write this spot, and this is futures. Within a few days of buying it, the spot moved to 112. The future would have moved to, let's say, 120. So today you are already making a profit of 10 rupees. But if you hold it till expiry, this might come down again and you might lose some of your profit, right? So is there a way that you can exit this at this point rather than waiting till expiry? Yes, that is possible. So one way is that you hold it till expiry. Another is that you exit, or it is called a square off. You exit or you square off your open position. Suppose you purchased a future contract of XYZ Limited. Please recall, please be clear about this. When you purchased a future contract, you have only promised to buy one share of XYZ Limited. You have not purchased the share. You've entered into a contract where you promised to purchase a share. Okay. And suppose in 10 days or 2 weeks, this has moved up, you are already making a profit. Now, how can you exit? You can enter into an opposite contract. That means you enter into a contract to sell a future of XYZ Limited. If you have an open position and you enter into an offsetting position, opposite position, in this case, you already purchased. Now you enter into a sell contract. After this point, whatever happens, whether the prices move up or down, when you enter into this contract, you purchased it for 110, right? Remember, you purchased it for 110, it moved up to 120. So you purchased it for 110 beginning of June. And now mid-June, after a few days, you don't want to wait till expiry. You enter into a sell contract. Now the price is 120. After this point, if there is any movement in the prices, you will not be affected because you don't have an open position. Your position to purchase and sell is completely offset. This is called squaring off. Your position is squared off. You don't have an open position anymore. Because whatever prices move up or down, the loss arising in one contract will be offset by the gain arising in the other contract. So basically, you've closed your position. You are indifferent to price movement after this point. When you enter into this contract, after that, you don't have a stake. You don't have a position. Whatever happens to the price, from then onwards, the price may become 5 times or it may fall to 10% of the price. It doesn't make a difference to you because you have bought and sold. Both the contracts are sealed. Done. Okay. So this mechanism is called, this mechanism of exiting before the expiry is called a square off. So you don't have to necessarily wait till the time of expiry. And in this case, obviously, there is no question of delivery. Delivery only happens at the time of expiry. This is you purchased a contract and you sold it again. That's all. Right? Before I move on to the next part, any questions so far and any questions on this? If it is not clear, I'm happy to explain it again. Future price will equal to spot on expiry. Yes, at the time of expiry. Okay. So suppose today I'm beginning of June, I'm entering into a contract purchasing futures of XYZ Limited expiring on 30th of June. But on 30th of June, if I'm entering into the same contract, I'm promising to buy a share of XYZ Limited today itself, no? Because I'm already at 30th of June. So at that time, the future price will not be very different from the spot price. That also in the morning. By the time you come to market close, it will be the same as spot price. Because we are no longer talking about the future. 1 hour before the market close on 30th of June, I'm saying that I'm promising to buy a share of XYZ Limited after 1 hour, right? There's just 1 hour left for expiry. And as we come closer to expiry, the future is like, it's like the future is becoming now. So the future price and spot prices tend to become the same. At the time of expiry, market close, it will be exactly the same. Hedging is something different. I will explain. How the lot size of shares decided, I already told you. One thing is that the regulators want that there should be a certain threshold. People entering into futures contract should not be allowed to enter with very small amounts to protect the small investors. And it also depends upon the price of the share. Okay. So if the price of the share is very less, then the lot size will be more to make sure that it requires at least a certain, sorry, a certain threshold amount to enter into the futures market. Why is there a difference between buy and sell price of the same futures? No, no, no. There is no difference between buy and sell price of the future at one point. In the example that I just gave you, we purchased the share beginning, we purchased the future beginning of June 110. Then the prices moved up. And middle of June, we enter into a sell future contract for 120. That is because the market prices have gone up in a few days. Okay. At one point in time, you don't have two different prices. These are two different prices from two different dates. Yes, Ashimaji, yes. Middle June, it will only be cash settlement. Okay, no delivery. I'll explain the mechanism. It is, yes, there cannot be delivery unless there is expiry. So the concept of delivery settlement is only applicable if you're holding the share, sorry, if you're holding the contract till the time of expiry. Yes, you can also enter into a sell futures contract. Let me discuss that. Dinesh, yeah, I'm not understanding your question. 95% means in future contracts. Ban, what ban are you talking of? Please elaborate your question. I'm sorry, I'm not able to understand. Okay. Meanwhile, let's move forward. And so you can enter into a selling contract. So you can enter into a contract for selling futures, which means nothing, but you are promising to provide one share for the agreed price at the time of expiry. That is all it means. So you can be a buyer or you can be a seller. If you enter into a future contract as a buyer, suppose this is you and this is the future seller, you have a right, and the right is that you will receive the share at the time of expiry, but you also have an obligation. The obligation is that you will pay the agreed sum of money at the time of expiry. Similarly, the seller also has a right and an obligation. Both the parties have a right, both the parties have an obligation. You are not making the payment now, you are paying a margin. I'll come to the margin part. But other than that, you are not paying for the share now, you are not getting the share now. It will only happen at the expiry. And the expiry can be the last Thursday of this month, or the last Thursday of next month, or the last there are three types of contracts available at any given time. If today you open the market, you want to buy futures of, let's say, Asian Paints. So you can get a future of Asian Paints that is expiring in June, or you can get one that is expiring in July or August. These are three different contracts. You can buy any one of them. And this is applicable for the indices also, the various index futures also, right? Now, remember I told you that exchange acts as a counterparty in such transactions. Okay, so exchange ensures that at the time of expiry, you will be able to meet your obligation. You will not dishonor the contract. How does the exchange do that? See, just like in the case of sweets, you pay a small token amount, maybe 10%. In this case, it is not sweets. So the amount that you pay upfront is slightly, it's calculated in a different way. It might be 10-15%, it might be 30-40% also. But you don't have to pay the entire amount, you just have to deposit it as margin. If you have some money in your trading account, out of that, the margin amount will be blocked. That means you cannot trade anymore with that much money. So for example, whatever amount you have in your trading account, let's say the share is, the future is 110. Okay. And let's make it round number. The future is 100 and the lot size is 10. A lot size is also 100. So the contract value is 10,000 rupees. Okay. You don't need to pay the entire 10,000 rupees. Suppose the margin requirement is 20%. So then 2,000 rupees will be blocked. This is your margin contribution. This is to make sure, see what happens is, you purchased it for 100, right? Now, if tomorrow the prices start to go down, if the prices start to go down, by the time it reaches expiry, if there's a big loss, you might not be able to pay for the loss. So even if you don't have to pay for the entire settlement right now, you pay a small amount, maybe 20% of the contract value, maybe 15%, maybe 25%. It differs from share to share. And that much money is blocked. This margin money now cannot be used for buying something else. Till the time this contract is open, this margin money is stuck. It's still there with the trader. It is not paid. Sorry, it's still there with the broker. It is not paid to someone else, but it is blocked. Tomorrow, if the share prices start to go down and your losses are increasing, you might have to add a little more. This 2,000 might become 3,000. So this is margin money. Once this money is blocked, every day as the share prices are moving and as the future prices are moving, this margin money is, this margin requirement is, there's a process called MTM, mark to market. If there are more losses, the broker will call for more money to be deposited as margin. Or if you already have that much money in your trading account, a little more money will be blocked towards this. Okay, this will ensure that at the time of expiry, if you hold it till expiry, at the time of expiry, you will have enough money in your account. Okay, so this is how exchange ensures that there is no counterparty default risk. This is not just in the case of buying a share, buying a future, it is also in the case of selling a future. Because you sell it for 100 today, it is possible that the prices move up and tomorrow or upon expiry, you have to buy it for 120. In that case, as a seller, you will be making a loss. So whether you are buying a future or whether you are selling a future, in both the cases, you have to deposit certain amount of money as margin. That margin, every day profit and loss is calculated. If it is a profit, no problem. If it is a loss, then you have to increase the margin. You have to deposit some more money. If you already have that money with the broker, then it is just that that much money is blocked. You cannot use it for buying another share or something else. It is earmarked in a way separately for this. And every day this profit and loss is calculated and the margin requirement you come to know. So whether you have to deposit, if if you enter into a contract and then you don't pay the margin, or you paid the margin but there's a loss, more margin is required, you don't pay that, then depending upon your relationship with the broker might exit the position. The broker might square off the position, just because you're not paying more margin to stop the losses over there. So in a way, this guarantees that there will be no dishonor of contract. Okay, so the exchange and through the brokers, they are acting as intermediaries. Yes, if you're not paying the margin, the broker might exit your position, might square off your position. In future, do we have CE and CE sell? This is terminology is related to options, not futures. We'll discuss this tomorrow. Which day is considered as expiry day? It is the last Thursday of the month for shares. Okay, for futures. Okay, for options, index options that we will discuss tomorrow, it is the Thursday every week. And in case that Thursday is a holiday, then it's the day before. So if Thursday is a holiday for the stock exchange, then it is the Wednesday. If that also is a holiday, then the day before, Tuesday. Now, squaring off is not the same thing as a spread strategy. Spread strategy is a strategy where you buy or sell in a certain combination. Squaring off just means I entered into a position and then I entered into offsetting position, so that net I am in a no profit, no loss. I exited the position. I squared off my position. It is just a transaction. See, broker might square off your position if you're not paying the losses, if you're not paying the margin amount. Otherwise, the broker can never do that. Okay, Dinesh, your question is interesting. If you have to square off, but there is no one in the market to take position, that normally never happens, because futures and options trading is only allowed in large companies which have a lot of liquidity. It is not possible that there is not a single buyer in the market. We are not talking of penny stocks here. We are talking of large stocks. And we have thousands and lakhs of people who are participating in the market on a daily basis. If you look at the volumes, I don't think we'll be able to cover the volumes today. We'll discuss that tomorrow. If you look at the volumes, it is not possible that you will not have a single buyer. Sumitji, I'm not understanding your question. Is future and option both are different? Can we use same logic for option? Let's discuss this question after we've covered options tomorrow. Maybe it will be clear then. How to find which stocks are FNO stocks? I will show you how to get the list from the website. Can margin size be fixed as per contract? Margin size generally depends upon the underlying. And if the underlying is more volatile or more risky, then the margin requirement can be more. It can be 25-30% also. It can be more. Why some scripts are banned in FNO trading for some days? Generally to avoid prevent speculation. How is the lot size of stock future contract decided? I think I answered this question, but no problem. Let me. So if the stock price itself is low, then the lot size is bigger. Okay, just to make sure that the amount required to enter into future contract is slightly higher. Someone with 1,000, 2,000 rupees does not get into that contract. This is to protect the small investors. Also, depends upon the volatility and the risk involved in the stock. Whatever loss you incur depends upon the price of the security. At what price you purchased it? Suppose you purchased it at 100. Whether it is a share or an FNO, particularly in the case of FNO, if you purchase it for 100, now it has come down to 90. You're already making a loss of 10. That is covered by your margin. So the broker is okay, but the broker is asking for more money to be deposited as margin. If you don't deposit it, then the broker will exit your position, square off your position at 90, and this is your loss, 10. Broker already has that money because initially you put some margin, right? You will not get that money back. Profit and loss calculation is exactly the same. At what price you purchased it versus what is the price right now. Is future and forex trading are the same? Okay, let's answer that. What is a future? A future is basically a derivative contract where you are promising to buy or sell a share, or it is for an index at a specified period of at a specified point in time. Okay, so June expiry, July expiry, etc. Forex is a term for foreign exchange. That means foreign currency. For example, US dollars. So when you say I'm a forex trader, it means that you are trading in foreign exchange. But futures is a derivative contract. And generally, when we say futures, it is related to, it is standardized, listed on a stock exchange, normally related to shares, but it can also be related to oil and other things, other commodities. It can be relating to forex also. So it can be a future contract to buy forex or to sell forex. You have those kind of contracts in dollars, for example. Dineshji, I'm not able to understand your question about 95%. I'm not sure what this is. maybe we can take it later on offline. Okay. Now, let's come back. I think pretty much every question has been answered except one or two, or except the questions relating to options, which will be covered tomorrow. But let's understand, since most of you are new, when I said that futures and options, or derivatives in general, are amongst the most riskiest option available, riskiest trading opportunity available. Why is that so? I'm not saying that you should be a trader in futures and options, or you should not, you should avoid futures and options. I'm not saying, I'm neither recommending it, nor am I asking you to stay away from it. But it is very important that you understand the risk and reward. That is all. Then you take a call whether it is for you or not, how much risk you are willing to take, etc. So let me explain you why it is risky. And today we are just discussing futures. Tomorrow we'll also discuss options. Suppose a share of XYZ Limited is available in the spot market for 100. It's a large company. It's a blue chip company. So it is big. It is relatively stable. There is no risk of this company disappearing in a few months, or suddenly everyone realizing that this is just a scam, and so there is some genuine value in this, and there is very little chance, negligible chance, that the price of this company will come down to 5 rupees in 2 months. All right, this is not a penny stock. That is what I'm saying. So there is credible value. Now, if you believe that the price of this company is going to go up in the near future, maybe a month, maybe 2 months, whatever time period, if you're expecting an appreciation in the price, there are two ways you can make profit out of it. The first strategy is that you buy the share. You pay rupees 100 today, you buy the share, hold it. You have paid 100 rupees. Okay. You hold the share. Suppose the prices actually move up to your expectation and it becomes 110 in a few weeks' time, at which point you sell the share, or let's not make it 110, let's make it 108. Okay, so you sell it at this point and you make a profit of 8 rupees. You purchased it for 100, you sold it for 8 rupees. What is your return on investment? What is your ROI from this transaction? It is 8%. You invested 100 rupees and you made a profit of 8 rupees. Is this clear? Now, the second approach could be, this was the first approach. The second approach could be, instead of actually buying the share, you buy a future of this share. All right. Now, when you buy a future of the share, you don't have to pay the entire 100 rupees upfront. You don't have to pay it upfront in the sense the entire contract value. That is only paid upon expiry. You only have to pay a certain amount as margin. Let's say the margin is roughly 20% for this kind of share. So when you enter into the future transaction, you don't pay 100, you only pay 20. Okay. And upon expiry, this is available for 108. Okay, you still make a profit of 8 rupees, but your investment was only 20 rupees. So in this case, the ROI will be much, much higher. Here you are making a profit of 8 rupees by investing 100. Here you are making the same profit of 8 rupees, but by investing only a small amount, only the margin amount. So this is why this is called leverage. Okay, you're not paying the full amount, but you are reaping the benefit of paying the full amount. So this is also called leverage. Now, in this case, Since the price movement has been favorable, it has been in your favor. You are seeing that instead of 8% profit, I'm making a huge profit, like around 40. I'm making 40% profit in the same transaction, same share. Have the prices not moved according to your expectation? If instead of this 100 becoming 108, if the share prices would have fallen from 100 to 95 or 90, you would have made a small loss in the first case. You would have made a loss of 5 rupees or 10 rupees, depending upon how much the share has fallen. In this case, the losses will also be magnified. So, because of leverage, because of the fact that you are reaping the full benefit, but you are not paying the full amount upfront. Another way to see this is, if you have only 100 rupees, you can buy one share and keep it. And then when you get an appreciation, you sell it. But if you enter into a future contract for the same share, you can buy actually 5 future contracts with the same 100 rupees. And here your profit in that case would have been not 8 but 40 rupees, because you're entering into 5 contracts. With the same 100 rupees, you can buy 5 contracts. So you are getting the profit of 5 shares with the same amount of money. However, in case it is a loss, the losses are also magnified. In this case, the loss is 5-10%. In case of derivative, in case of selling a future or buying a future, same transaction, but instead of delivery, instead of physical share, you enter into the futures market. Your loss could be 50%, 60%, 80%, who knows. So losses as well as profits are both significantly magnified when you do the same transaction through derivative market. That is because of leverage. This is why you should be very careful about, it's important that you understand the risk and reward. The reward is also high, the risk is also high. And see, normally if you deal in shares, large companies, blue chip companies, stable companies, their share prices will not move by 50-60% in a small period of time. Maybe penny stocks, it is possible, but in large blue chip companies, it is rare. It is not possible, almost impossible. But but for futures and options, even for large companies, because of this leverage game, it is possible that you might lose 90% of your investment. All right. Premium is only for options, not for futures. What is the criteria for allowing the stocks to trade in derivatives? Well, frankly, I don't know the exact technical details of it, but generally it is the relatively large companies. You don't have derivative trading in small and penny stocks. But what exact criteria, I don't recall. I'll have to check. Generally, it is the large companies. And even amongst the large companies, if due to a certain situation, there has been exceptional price movement, erratic price movement due to some news, like for example, something is happening, some regulatory issues. So some stocks are at times banned from F&O trading for a certain period. Can we participate in future contract as trader under equity market time? No, it has the same. Okay, so the time for trading in F&O is the same as the time for trading in the stock market for buying and selling shares. So it opens at 9:15 in the morning and closes at 3:30. Margin trading, this is what margin trading is, that you are going to get the benefit of entire appreciation of a share, but you pay only a small percentage of that. Or in other words, in the example we just saw, instead of buying one share and keeping it, you can buy futures of 5 shares of the same company and keep it. And then you will get the benefit of share appreciation of 5. 5 shares. But obviously, if it doesn't go according to you, if it goes in the other direction, the losses are also magnified several times. So is mark to market losses calculated? How is mark to market profit or loss? Both how it is calculated. You purchased a future contract. At that time, the price was 100. Uh, the next day, the price goes to 105. So you are having a mark to market profit of 5. If it goes down, if it goes down to 95, then you have a mark to market loss of 5. So we need to have some extra amount to avoid square off by broker, right? Yes. So usually you will have some extra amount in your trading account. It also depends upon your relationship with the broker and what kind of an account you have. So this you need to check with your broker. But generally we have some extra amount. That money, as and when required, gets blocked towards margin of this transaction. And if required, then the broker will inform you to deposit more. Can you have a demonstration in the live market in the next class? Well, the next class on this is tomorrow, where we'll discuss options. But there are also classes where we show these things in a live market, live terminal during market hours on weekdays. Please get in touch with the support team and they'll guide you about when is the next class happening or how you can enroll for that. Couldn't understand how loss is high. Okay, let me take one example of the loss situation as well. Okay, Dinesh, NPA, there's no concept of NPA in futures because whatever is the possibility of loss, that much money the broker always takes from you in advance in the form of margin. And that is how the exchange ensures that there is no default. We might discuss some strategies for trading, but not today. Because see, most of you are new. To understand the concept of derivatives and in the same class to discuss strategies, it becomes a little difficult, right? I'm sure you'll appreciate that most of us are still understanding the concepts. Can a practicing CA do futures and options? Well, I believe that last year there was a, whether it was a few months ago, there was an announcement by the ICAI allowing CAs to do little bit of futures and options trading. But anyways, many of them are doing it even if they don't do it in their own name. At the end of expiry, I full pay total amount. Will I get delivery? Yes, you will have to compulsorily take delivery if it is a share. If it is an index, you cannot take delivery. You cannot take delivery for an index. There is no real underlying. It is just a number. So there it is cash settled. But if it is a share, then you get delivery and you have to pay the full amount. Is Nifty index the best for beginners to start trading in futures? Let me tell you something about Nifty. It is, if you talk about volumes, it is one of the highest volume derivative contract in the world, amongst the highest. All right. So, uh, so it's a very good place to start because there is enough liquidity in the market, there's enough depth in the market. But you have to very clearly understand the risk and reward. It is risky. Any future, any derivative trading is risky. I will take an example of loss in future. If you square off a position, then whatever loss or profit, you are going to receive it immediately because there is mark to market on a daily basis. If you keep it till expiry, then if it is a share, you either have to provide the share or provide the money and get the share in your account. Then you can sell it or, to get the profit. Or you can keep it if you want to keep it in your demat account. Open interest. Let's cover open interest tomorrow when we are doing options. I will also show you futures open interest because we've kind of run out of time now. We have run out of time. And I have to explain this concept once again, showing a loss situation. It's important that we clarify the concepts. Tomorrow I can show you the rest of the things. Okay, so let me go back to the whiteboard and show this to you using a loss situation. Suppose you purchase the share for 100, expecting it to go up. But that didn't happen. So instead of going up, it went down to, after 1 month, it went down to 90. How much is your loss? Your loss is 10%. 10 rupees, 10 rupees loss, 100 rupees investment. So your loss is 10%. 10 rupees has become 90 rupees basically. Now, instead of buying the share in the spot market, if you had purchased a contract in the future market for the same share, let's say that was available for the same amount. Theoretically, ideally the price will be slightly different, but let's say it was available for the same amount. Did you have to pay 100 rupees? No. You just had to pay, let's say 20% of that. So you would have only paid 20 rupees. Instead of buying one future contract, since it was available only for 20 rupees, instead of buying one future contract, you decided to buy 5 future contracts. So you purchased 5 contracts for 100 rupees. In this case, you have invested 100, but you got only one share. In this case, you have invested 100, but you've got 5 contracts. Now, if you make a loss of 10 rupees per contract, sorry, just give me a moment. Yeah. If you now make a loss of 10 rupees per contract, the total loss is 50. All right. So you invested 100 rupees and your loss is 50 rupees. So your loss is 50%. What is applicable? The magnification of profit, the amplification of profit. The same thing is also applicable for losses. That is why derivative contracts are very risky. So it's okay to deal in derivatives, just be aware of what the risks are. Because the reward is also high, so it justifies the risk. Okay. How to carry over future contracts. Now, if you are coming close to the expiry and you want to continue the position, what you can do is, see, I told you that at any given time, you have 3 different options available. You can buy the immediate expiry. For example, right now it is June, or you can buy the next expiry contract, that is July, or you can buy the next expiry contract, that is August. When the June expiry contract will actually get expired, last Thursday of June, then a new contract will open up that will be for September. So at any given time, you have three different contracts for the same share or same index. You have three different contracts: the immediate month, the month after that, and the month after that. So when June expires, that time September will open. Then you will have July, August, September. All right. So suppose towards the end of June, I don't want to exit the position completely, but what to do? June contract is expiring, right? So I will exit the June contract. I'll square off the June contract and open a new position. I will buy a July contract. All right. So that way I can keep rolling my position and always have that position open. This is called the rollover of a future contract. I hope it is clear. Ankit ji, I hope your question about amplified profit will be settled on expiry is clear now. See, what is happening is, as and when you are making a profit, on a daily basis, it is getting added to your margin or it is getting removed from your margin. I mean, it is marked to market on a daily basis, right? So if you square off the position, you don't have to wait till expiry to get the profit, because the moment you square off your position, then there is no more mark to market. Whatever is there in your margin will be released and you can get it back from your trading. If you want it, if you want to receive it in cash, you can get it back from your trading account to your bank account. Whatever margin is blocked, when you square off the position, that margin will also be released. Open interest. We will cover open interest tomorrow, but I can just tell you the definition right now. So open interest is nothing but if A and B entered into a future contract. Okay, this is one contract that is outstanding. If tomorrow A also entered into a contract with C, now we have two contracts that are outstanding. All right. Similarly, every day a number of people are entering into new contracts. On any given day, the number of contracts outstanding for that particular future, for example, Reliance futures you want to see, or Nifty 50 futures you want to see, how many contracts are outstanding? One contract means two parties. This will not be counted as two, this is one only, one contract. So how many such contracts are outstanding? That is called open interest. That's all. So basically, it's like when you're dealing in shares, you refer to volume. When you're dealing in futures and options, you refer to open interest. It tells you, it's like volume only, how many contracts are outstanding. See, shares, for shares, futures expiry is futures and options. The expiry is monthly. So it is last Thursday of every month. For index and only index options, you have weekly expiry. We'll discuss it tomorrow when we are discussing options. Okay, so Jayantaji is asking a question. If C sells to B, what will be the open interest? Let's see. A is the seller. There's a contract between A and B. B is the buyer. This is one contract. Similarly, there is one between A and C. C is the buyer, A is the seller. Now you're saying that C sells to B. Right? That means for C, there is no open position. Okay. But B has now become the buyer in two contracts. So this contract is still valid. Instead of being with C, it is now with B. So A is still the seller in two contracts, and B is now the buyer in two contracts. So when C sells to B, open interest does not change. Okay, open interest was 1, then it became 2, and when C sold to B, open interest still remained 2. Hope that was clear. Okay. ओपन इंटरेस्ट की कोई लिमिट होती है क्या? नो सर, ओपन इंटरेस्ट की कोई लिमिट नहीं है. नहीं, there is no interest. There is no limit to open interest. It's like volume. How many transactions are happening? No limit. Okay. So we have overshot the time, so we'll have to close the class today. Whatever is pending from today, plus if you have more questions, plus all the questions about options, obviously that will be covered today. If you have more questions from today, don't worry, we will take all of them. We will clear all of them tomorrow. I hope you found this class useful, and if you have any other questions, please note them down. We'll discuss them tomorrow. We'll be doing options in much detail tomorrow. Thank you for your compliment. And no, it's okay. Answering question is part of this job. So it is very satisfying. Honestly, it is very satisfying for me when participants are so active and asking questions, because it gives me satisfaction that there is communication happening and this class is having some meaning. It's very scary as a faculty. It's very scary for people to not ask questions. Thank you so much for your compliments. It means a lot to me. Thank you. Have a nice day, and I'll see you again tomorrow. Thank you.